please. All right.
I got to look at the camera.
We are live.
Uh-oh. We on?
I think so, yeah.
Okay. Good afternoon, everybody. Welcome to our latest webinar today. We're going to tackle one topic, which isn't typical of us. And that topic is going to be the employee retention credit. Our room is filling up, so we're going to give it a couple of minutes to continue to fill up, and then we'll get started and get through this pretty quickly today.
Should we tell them you had a long Memorial Day weekend?
Yeah. Also,
Bob had a long Memorial Day weekend.
Right. You know what happens when it rains on Memorial Day weekend? You have to go somewhere where it doesn't rain.
So, let's see.
Hopefully none of my clients are.
What?
I answered all my emails.
Like another minute or two and we'll get started. Lauren's on there many times.
It's nice today. Tonight's going to rain. Tomorrow's going to rain. I'm going to St. Michael's on Friday.
Maryland?
To see clients. Yeah. It's about 177. It's on 1201.
Yeah.
Give it a couple more minutes and then we'll get rolling here. These slides are all going to be up, right?
Yep.
Okay.
I think so.
Oh, that's so funny. I'm going there Friday.
Kevin will not be there.
Yeah.
So, yeah.
Right, you're at the house down there.
Should we just go through the initial stuff while we're...
It's on 1202. Let's give it 2 more minutes and then we'll get started. We don't want to have to repeat. And there's a lot of information that may have changed since the last webinar we had a few weeks back. So we want to make sure we everybody catches this. This is a big giveaway at this point. So I want to make sure anybody that thinks they can apply for this is able to apply, because there's a lot of subjective definitions in here today about who qualifies for this credit. So we're going to try to cover as many as we can. We've got a couple of examples that actually just occurred within the last 2 days. So we're going to share some of those stories as well with clients of ours who are trying to get this credit. And it goes away at the end of the year. So.
New form.
3, let me think.
I think just maybe 1 more minute and then we'll probably get started.
She does nice work.
She does, yes. Stuff. Thank you, Lauren. She does make it a lot easier to do this. And the slides look a lot nicer. There's less than 75 different fonts, which is always good. Let's do it.
All right, let's get started. Since we're over the 100 member mark, we're expecting about 150 today.
175.
So 175, corrected. So it'll be a pretty lively group. I'll introduce myself. My name is Bob Simpson. I'm the managing partner of Brinker Simpson and Company. And with me today is Kristen McCabe. And Kristen is our head of business development at Brinker Simpson and has morphed into the role to lead our COVID response team, which started 15 months ago, I guess. Hard to believe that it's been 15 months. But the idea that Kristen and I had back then was when legislation started back in March of 2020, we realized that that legislation The initial piece was the PPP loan, which has pretty much become a household word at this point. We knew that many of our clients would be eligible for that money, so we got out in front of it, learned it very quickly, and as all the changes came through, stayed on top of those changes as best we can. And we dedicated a team here now to try to move people through all of these programs. We had tremendous success with PPP and PPP2 and some forgiveness. We've had success with other employee-related eligible relief packages, and we're working today with the Employee Retention Credit, ERC, which we have presented a few times prior. And it's really I'll call it the final remaining piece of legislation that's still allowing people to get money. And it is a tremendous amount of money available here. There is no limit to it. It's an IRS, Treasury Department tax credit. So it doesn't have anything to do with your banks or SBA, and I'm sure the bankers are happy about that. There is no forgiveness provisions in this. You get the money as a tax credit against your employee taxes. The one little difference with ERC that is not, the other programs is that the ERC credits are taxable. So in the past, you remember PPP and PPP2 originally were taxable, forgivable loans. If they were forgiven, they were taxed. And then the government came along and bowed to a lot of pressure from small business owners mostly, and from organizations like the American Institute of CPAs to make that income or make that forgivable loans tax-free, which they did for last year, which was certainly a nice benefit. And the PPP2 money is tax-free as well. There won't be any conjecture, or there won't be any problems with that. Brinker Simpson is a regional CPA firm. We're located outside of Philadelphia. We have a 50-person staff here, and we are just completed a very busy tax season. We're in the middle of our audit season. We have a valuation team here that is very busy now with a lot of changes going on in anticipation of the Biden Tax Act, which came out last week. We have a fraud and forensic team, a litigation support team, and a managed accounting service team here as well. Our client base is typically companies that are $5 million of revenue to $50 million. We do have outliers that are larger companies, and we certainly have companies that are pre-revenue who get on board with us from the very beginning to make sure and allow us to guide them through all of the nuances of being an emerging business. So all family-owned businesses. We don't have any public companies here, so we stay away from that arena. We allow the experts in that area to take care of that. So we work very closely with our clients. I say that to the clients that are on the call and the non-clients on the call as well, that we pride ourselves in being very responsive and very close to our clients from partner level all the way on down. So that's what we do. I'll just go through the disclaimer that we are not giving advice through this talk, although it sounds like we are. And we do recommend that you connect with your CPAs and your other professional team to make sure that anything you pick up from this talk today is cool with them as well. So that's what we do. We're just a couple of housekeeping things. To use the Q&A for questions. What we'll do is talk for a half hour, and then we'll go into Q&A. And we have prided ourselves that we won't leave until we answer all the questions live. If you have a question, you may want to sit on it for a little bit and see if it gets answered through the presentation. And if it doesn't, then pop it into Q&A, and we'll make sure we get to it. We get a lot of questions become repetitive sometimes. So hold on to your questions and we'll get to them. We don't answer them typically during the presentation. We'll just wait to the end. The slides will be emailed after the presentation. We do have a website set up just for COVID material. It's called BrinkerSimpsonCares.com. So if you go into, you can go into our main website and get right into that, and it'll have up-to-date information on any of the programs that came out regarding COVID, and that's up to date through today. So as they As changes are made, we do pop them into that website, so you have access to them. Also, you can follow us on LinkedIn the same way. Our email address is cares@breakersimpson.com. If you have questions, they will go to our COVID team, and they get answered very quickly to the best that we can. We do get a lot of questions after these webinars, so give us a little bit of time and patience, but we will answer yours for sure. So our agenda is up on the screen for today. Here's the list of what we're going to go through.
Sorry.
That's all right. You're good. I can just move into that. So it's all about employee retention credit today. And for anybody who has engaged with us to get their ERC completed or started, that's great. They've been through the process. For those of you who have not, we do offer that. So you can engage with us to help you through the process. We have found, and you can comment on this, but that payroll companies have taken the lead on some of these. Originally, payroll companies were coming out and they were charging some exorbitant fees based on percentage of tax recoveries. And then as these tax recoveries became substantial, we have a client who's getting about $1.5 million per quarter. And payroll companies were looking at anywhere from 10 to 20% of the tax recovery as their fee, which is, I wish I could do that with clear conscience, but we can't. But we work in, I think they came to their senses a little bit.
I don't know.
You don't know.
I think we decided to do this webinar because we're hearing from a lot of business owners that either their accountants or someone told them that they were not eligible for ERC. So there's a lot of relief available, and there's a lot of different ways that you can access it. So the way you run your receipts for a lot of companies, you can do it in several different ways. And there's some guidelines for partial suspension of operations that might render you eligible. So we had some people reach out who were eligible for over, multi-million-dollar relief that were told they weren't when they very clearly were. So we wanted to just refresh everyone on the rules and also offer you an opportunity to connect with us to see if we can help connect you to that relief if you're eligible. But yes, the payroll companies initially were actually more helpful, but now they're starting to try to push their clients towards credit companies that are more closely aligned to like an R&D credit. So they're going to charge a percentage of the fee, which you really shouldn't have to do. So try to not get into that situation if you can.
Yeah, we do have an example later in the presentation today of what kind of information you need. We have a template that we can send out that gets it started, and you'll find that it's not difficult to compute the credit. Difficulty comes in when you're trying to balance different credits that are available to you. You want to get the maximum amount of money. That's the whole goal here, is to get the maximum amount of money of all the programs that exist. So PPP and ERC and R&D credits, items like that, you want to make sure you're capturing the maximum amount. We'll talk about PPP forgiveness a little bit. We have been one of those proponents that have been the bane of bankers that have told their clients not to apply for forgiveness yet until you've addressed all the ERC issues. Once you're clear on ERC, whether you qualify or not, then you can get your PPP forgiven. It's a quick process for most people. You already have the information together to get there. So let's talk about the history of the ERC. So it is $1 a credit. It's a tax credit. It's a dollar for dollar reduction of a tax liability, and that tax liability happens to be the payroll taxes that you're paying on your Form 941, your employee withholdings and matching taxes on your 941 returns. That's where the credit gets applied. So it reduces your outflow of cash when you pay your payroll taxes. Now, the way it works is you are going to just reduce and alert your payroll company to it when you make your payments for your 941 taxes. Now, many companies, us included, have those payments impounded automatically. So if we qualified for this, we would have to make sure our payroll company is fully aware of the amount of the credit and how much credit we're taking against those taxes, if not the full amount. The other way to do this is by filing a Form 7200, which is it's almost a refund form where you're asking for amounts to be advanced to you in lieu of taking the credit on your payroll taxes. So an example, we have a company that got $1.5 million of ERC credit for the first quarter of this year. They had already paid their payroll taxes for the first quarter. They were going to qualify for the second quarter as well, and they could use the second quarter ERC to reduce their second quarter withholding taxes, but they had this $1.5 million hanging out there that they were entitled to, and they didn't want to wait for the money, so they filed Form 7200. It took about 8 weeks.
About 8 weeks.
Yeah, about 8 weeks, but they did receive a direct payment from the IRS for that $1.5 million at the same time getting the credits moving forward. So if you do qualify and it's a large amount and you don't want to wait to take the credit every pay period, you can file that form. Just be aware that it's an 8-week turnaround that we've experienced with receiving the money.
I think it'll get faster. I think last week was the first week we start to see a lot of checks, actual checks, 6-7 figure checks from the IRS coming in from the first quarter returns and Form 7200. So I think they might be now putting people on this. Hopefully that makes it a little bit faster, because that's the intention with the 7200.
Yeah, so this credit you'll see is a retroactive credit to 2020 if you qualify, and it's a current credit for 2021 if you qualify. The amounts for 2020 are much less, and the qualification is much more strict for some companies than it is for 2021. And recently, the Biden administration had extended the credit, which was scheduled to stop at June 30th. They extended it through all 4 quarters of this year, so it became double as valuable than it had been earlier in the year. So the first step at the bottom is determine if you're eligible or not. That's the most important part. Here's a little history of the maximum minimum amounts for each year. You'll see that for 2020, you had to have a 50% reduction in your revenue in a calendar quarter compared to 2019. If you met that reduction, you qualified for that quarter, and you qualified for every quarter after that until you moved back to 80% of the prior year's sales. It only qualified companies that had less than 100 employees.
For only if they were paying wages to people.
Paying wage, exactly. And it was a maximum of $5,000 for the year, which was 50% of a $10,000 per employee maximum payroll. So you could get $5,000. Last year was the maximum. Then that employee didn't qualify anymore. So if you had one quarter and all your employees made $10,000 or more in that quarter, and you qualified for everybody in that quarter, that would be the maximum, the credit for the year. Even though you may qualify for the next few quarters, if you don't have new employees, you would have to, your credit would have been used up in that one quarter. Now that's all been changed for 2021. You'll see that the eligibility is that you are a 20% reduction in revenue between the 2021 calendar quarter and the 2019 calendar quarter. So you're going back 2 years. 2019 was your last year pre-pandemic, and that's why they're using that year. So make sure you go back to the year that was probably better for most companies than 2019 was. The credit has been increased to 70% of payroll, up to $10,000 per quarter, not per year. So each employee who makes $10,000 a quarter, you could get a $7,000 per quarter in credit, $28,000 if you qualify for all 4 quarters of that year, as opposed to a $5,000 maximum credit going back to 2020. You can still go back to 2020 and amend the forms for that year to get the credit. But you can also look at 2021 as you go forward. We're going to say that we're working with a company now that was told by their accounting firm that they did not qualify for employee retention credit. And after they consulted with us, they're going to average about $900,000 per quarter. Now, you know, this company was struggling, but they're going to get about $3.6 million in employee retention credit because they maintain their payroll, they maintain their payroll levels. Their employees are all full-time, and they're working at a wage base greater than $40,000 per year. So they're going to realize about $3.6 million this year in credits that they were told by their accounting firm they were not eligible. for. So be careful with that. If you're being told you're not eligible, you can reach out to us. Tell us your circumstances, tell us your situations. Like we said, we had a situation today and we can share that dentist story.
Well, it's a bunch of accountants on Twitter sharing.
All right, well, there's a story regarding a dental practice where the dentist had 10 chairs, but due to the 6-foot social distancing rule, had to remove 2 of his dental chairs. So he could only do 80% of his chair. Now, does that qualify for this year's a 20% reduction?
Yes.
Yes.
So, as long as that rule is in place to limit the capacity in operations, that I'm pretty clear, and the tax Twitter consensus agrees as well, that yes, that would qualify. So I think that area is a little bit, it's less clear, but there's a lot more opportunity there. And I think a lot of people will be eligible that don't realize it.
Yeah, here's, that's right. We'll talk about eligibility because eligibility is so important at this point.
Yeah.
The decline in gross receipts is very easy to determine. If you're a company that has less than $25 million in revenue, you can use
over the last 3 years, your average over the last 3 years.
So your average sales are less than 25 million. You can use either a cash basis or accrual basis to determine your reduction in revenue for that quarter. So we, for 2020, you needed a 50% reduction in revenue. And for 2021, you need a 20% reduction in revenue. So that's easy to measure.
And also just keep in mind for both years, 1 eligible quarter for receipts makes you automatically eligible for 2, because when you hit 50%, you're eligible until the end of the quarter where you're restored to 80. So if that happens in the next quarter, you still get it for 2020. And then for 2021, if you have a 20% drop, you can use that for the current quarter and do it retroactively with an amendment, and also elect to use that. You can elect the prior quarter to make you eligible. So I could elect to use March 31st if it was down by 20% for my Q2 and make that eligible, and also for Q1. So if you meet one of those tests, it will automatically make you eligible for 2 quarters.
And it's an either or here. So if you don't qualify due to the reduced revenue test, you can qualify based on what they call the partial or full suspension of operations. So if you think about it, and I'll use Pennsylvania as an example, Pennsylvania came in and closed companies from the state level, came in and used their state powers, whether right, wrong, or indifferent, to close companies based on the type of business they have. Let's talk about gyms, for instance. They came in and they closed gyms. They didn't give them an option to wear masks. They closed the business. So during that period of time, that gym would qualify for this. Now, the gym likely had a reduction in revenue of 20%, but use a restaurant, for example. If the restaurant was able to keep its receipts up, but had a portion of the business, inside dining, was closed, they would still qualify for this under the partial or full disclosure rules because they were from a government authority. They restricted their commerce, travel, or trade or group meetings, and the typical operations were affected. So what we'll do is,
so even if your receipts are down as a restaurant, because a government order limited your capacity to do business the way that you did before in a more than nominal way, you are eligible. So a lot of restaurants, like we see a lot that did well with takeout, and they are still eligible because they are impacted by these orders. So
these are just a couple of points here. So we talked about the average gross receipts. If you're a not-for-profit, you don't have flexibility on your basis of accounting. You have to use the basis that you use to do your 990 not-for-profit tax filings. Aggregation rules apply here. So if you have commonly owned companies, you have to aggregate revenue from those companies to see if you have a total overall decline. We have a lot of subjective banter back and forth, and even disagreement at the table and in the office on whether closing of one company due to a government order because of aggregation rules, even though your receipts weren't up, would that impact the other company that wasn't closed? So there's a lot of talk in there. We're not giving advice, but we're talking to our clients, and we're telling our clients that if you don't apply for the credit, you don't get the credit. It's not like you can go back next year and say, oh, by the way, I think I was impacted. I should have applied. You can always pay it back if it's denied at some point, but you can never get it back if you don't apply for it. So that's the only advice that we'll give.
You do have 3 years
today. 3 years to go back and do it?
To do the amended 941.
Right.
Yeah.
So they're giving you 3 years. So if you do change your mind next year, go back and get it. But our advice would be to get it now. You want to get it now before it runs out.
Definitely.
So let's talk about the partial suspension. This is where all the subjectivity comes.
Yes.
In this. So we use the word nominal in 2 separate ways. More than a nominal portion of your business operations are suspended by a government order, or more than a nominal effect on business operations. And we'll talk about the dentist chairs, for instance. Losing 2 out of 10 chairs is a nominal impact on the business. There never was a real definition of what nominal was, and then all of a sudden the 10% number popped up a few times. So kind of use that as a rule, even though your receipts aren't down by 10%. If there was a change in the nominal portion of your business, and that nominal would be a 10% portion of your revenue generation, or a 10% portion of your activity or services, then that would qualify as nominal. Although, I mean, is that in the rule? Or
it is. So this is actually recently released information from the IRS. And one of the examples that they give is a medical practice that would be considered essential. So they're allowed to do business. Typically, they wouldn't be considered partially suspended because they were deemed essential and the order doesn't apply. But if they have a line of revenue that is greater than 10% in 2019, in that same quarter, that is impacted. So if somebody has cosmetic type surgeries or appointments, and also traditional medical procedures that would not be canceled, limiting the cosmetic procedures and could potentially qualify the entire operation for eligibility. So the nominal in the portion of operations is really that one they've clearly defined with a number, meaning that the component of revenue that was impacted, or the component of the business that was impacted, has to be more than 10% of the total gross receipts. So it can't be you do 1 cosmetic surgery a year and you're a multi-million-dollar dental practice, and that wouldn't work. But if they're both relatively regular and the one is more than 10%, that would still qualify the entire business for eligibility. And then also they specifically list hours of service. So if your employees and the way that they do their business is impacted by more than 10%, that would also be a more than nominal. But then the second one is the more than nominal effect on business operations. And this is where I think everybody applies, because it doesn't give you a lot of information. So this is really a government order that results in a reduction of an employer's ability to provide goods or services in the normal course of business of not less than 10%. I mean, we moved to every single tax appointment to Zoom. Every single of our tax return was signed electronically. We weren't completely set up to be a remote company. I mean, I try to tell, that we should be eligible. Everybody should be eligible by this determination. And again, this would not be a quarterly basis. This is when the order is in place. So it's a little bit more work involved to document that you're eligible, but there's a lot of, there's orders everywhere. And the other thing to keep in mind with this is, if you do business in 3 states, and one of them is New York and New York City, the New York City orders that lasted until probably still now, you can use those orders to qualify the entire business. So if a portion of your business is in New York and you're a Pennsylvania-based company that's less impacted here, that order does give the entire operation eligibility. So I typically will look at it in terms of where do you do business and try to find the most restrictive places to try to find an order that way. And also, in what ways did the way you operate during that time change? And usually there's an order somewhere that was driving that. So it's something that I think everybody should at least look at, understand what the value potentially is, and consider talking to us or your accountants about if you might be eligible. Because I don't know, they wouldn't have given this eligibility criteria if they were only looking to let people do receipts, because I imagine if you were on target to grow your business by 50%, but you only grew by 20, well, you were still harmed because of an order. So
yes, yeah. So you don't need a revenue reduction to qualify under this definition. And in Kristen's last point there is no numerator or denominator identified. So use the accounting firm as an example that we had to adjust our methods very nominally to avoid contact with people. Even though our revenue didn't go down, it did change a significant part of our business operation. So could we qualify for this credit based on that definition? It's a very difficult decision to make, but like I said earlier, is you want to err in your favor, not in the favor of the government. So if they wanted to be clear on this, they would have come out with more with a clearer definition of what really has to happen. So they came out very quickly with, you've got to have sales reduction of a certain percentage. That's easy to measure. But then they also came out with, well, if the government made you do things to your business to change your business, even though you didn't have a sales decrease, then you would qualify under this code. Show me a company that hasn't had a significant change in the way they do business. I haven't found one yet. So we're going to move on. Here's a quick example of a restaurant company and how it's impacted. Restaurants are pretty easy to, you know that they were restricted for indoor dining. So because of the government action, they would qualify automatically, even though they may have, we do have a restaurant that had income that was 10% higher than the prior year. They could qualify because they had to build outside dining areas. They had to do delivery that they didn't have before, and they were restricted on their indoor dining, closed for a period of time because of their location. So that company, even though the receipts were in excess of 2019, could still qualify for this under the nominal impact rules from government action. And this is an example of that. Anything in here important?
I mean, they get really specific with the restaurants too, that this is when they're both closed, they would be eligible. And then they get more specific and say, now they're going to allow indoor dining at X%. You're still eligible because a more than nominal portion of your business, which would be indoor dining, is impacted by an order. And then they even go to 80%. And that potentially still qualifies you. If you're in Philadelphia or Pennsylvania, I think we've lifted all of our orders. So not, it would end. But and we also have to consider fire code when it starts to get to the lower percentages and how much you were doing. But restaurants are a good one to use if you are someone who offers an online and in-person service, because you did so before the pandemic. And then after, you're going to be able to still do the online, and that may grow, but your other component of your business is you're not able to do that because of an order. And if that component is significant, there's a potential that you are eligible.
Let's talk about qualified wages quickly, and then we'll get to questions. So which of your employees will qualify for this credit? It's based on full-time employees, based on the average monthly full-time employees from 2019. You'll see a lot of these rules changed as this act matured, because people were finding ways to front load employees. They were finding ways to add employees from related companies. A lot of these rules changed as we went along, but it's pretty clear that a full-time employee would work 30 hours a week or 130 hours a month. They're the employees that count for this computation. We always get back to the aggregation rules apply. In 2020, you had to have employees that were less than 100. In 2021, you can go up to 500 employees. In the full-time count is 100 or less. All wages paid to employees do not include wages paid to related individuals of 50% owners, that we'll get into on the next slide. And the maximum in 2020 was $10,000 per employee for the year, and it's $10,000 per quarter in 2021. Related party wages is a big issue. It's still not totally clear, but what we do know is that if you're a controlling shareholder, a 50% owner, your relatives do not qualify for this credit. So our client is owned by a husband and wife their 4 sons and 3 daughters-in-law all work for the company. And none of those 7 employees, even though they've worked for the company for 20 years, none of those 7 employees qualify for this credit. So the IRS, by putting this condition in there, is trying to prevent you from loading your employment with a bunch of family employees and grabbing a lot of tax credit. At the same time, they've hurt businesses that have had family employment during that period of time. A spouse of the owner is not included in the restriction so far. And whether the owner of the company's wages qualify or not is still the source of a lot of discussion and disagreement. Some say the owner is qualified because he's not disqualified by statute. Others say the owner is disqualified because of his constructive ownership with brother, child, father, and he's also the relative of those owners. So what have we decided? Have we changed?
I think so they're basically saying if I own my company 100%, my brother by this rule also owns the company 100% by constructive ownership. And because I am the sister of my brother, I am not eligible. Right. It doesn't actually say that in the FAQs or in the act really, but in the FAQs, it references a code section 52 something related to the work opportunity credit. And then in there, it references 267C, which is where this is coming from. But I feel like the IRS would have said owners are not included in the FAQs like they did with the related parties. So it's unfortunate that they have not been more clear. I personally think you take it because it's not excluded, and you'd have to get pretty deep into the code to try to support that they were excluded.
Yeah, so we are, as we assist clients through this, including the owners in the payroll computation, but alerting the client to the fact that it may be changed or it may not be changed. We just don't know. Of course, there hasn't been any audit of these yet since it's so fresh, but I would suspect there could be. One of the other changes is you'll see the 2020 ERC qualified wages can't exceed wages that were paid to the employee in the 30 days immediately preceding the start of the suspension. And again, the reason for that is front loading your wages for your employees during this period of time to get the higher credit. If you didn't have the same wages for the 30 days prior to this period, then only those wages are going to qualify. So you can't add all your high earners into and front load their pay into a qualifying quarter. You have to be careful with that.
Or hire your friends.
Right, or hire all your friends for one quarter.
They'll become eligible at 30 days. Basically.
Yes. Just remember, we did talk about the research credit, some of the other paid leaves, empowerment zone credits. PPP wages used for forgiveness, those wages cannot be duplicated and can't be used for more than one program. This is a new rule for it came in 2021. If you're a recovery startup business, you're established after February 15th of 2020. You have sales that are less than $1 million. If you meet some of those definitions, you could get up to $50,000 for this startup type business. And then if you're a severely financially distressed employer, one that has a 90% decline in gross receipts, but somehow is able to stay in business, you have to stay open. There is a higher amount of credit available, and it's a quicker credit. So if you fall into that category and you are still open, more power to you, because it certainly was not an easy year for you to lose 90% of sales. But you would qualify for a higher amount of credit if you're in either one of those two. All right, now we're going to just talk about what we call cross eligibility. And the cross eligibility is the carefulness that you have to be aware of, in that if you use wages to get PPP forgiveness, you can't use those wages for the ERC credit. So a while back, people talked about getting PPP forgiveness fully on wages only because they qualified over the 24-week forgiveness period, and they didn't need to include other costs or other wage costs in that computation. Now, if they use those wages for forgiveness and they go back and qualify for the ERC, they can't use the same wages. That's why our recommendation has been up to this point to wait on the PPP forgiveness until you're getting down to the deadline, which are starting to come up. Because the first loans that were taken in April of 2020, your 24-week period is going to take you to October. Your 10-month forgiveness period is going to take you into July. So by July, you've got to have your forgiveness done or applied for anyway. Yeah. So we're getting up to it now that we're in June. The months just seem to go faster as we get closer. But you want to be very careful with your PPP forgiveness so that you take advantage of as little payroll as possible and maximize the other costs and the other payroll costs so that you have more payroll eligible for this ERC. And remember, owners of companies were only eligible for 20,833, I guess, of payroll under PPP. So you have more wages available if you were an owner or a highly compensated employee over 100,000. So you would still have more wages available for the ERC because your wage for forgiveness is limited. Mm-hmm. Anything you want to add in there?
So it's like the way, I don't know how much everybody knows about the process, but in your payroll costs, there could also potentially be health insurance and the retirement costs and other things beyond wages. So you need to at least show 60% of them. So over your covered period, if your 60% number is like, so this is an example of a company that has 52 employees and their PPP loan is $750,000. They needed X amount of employee retention credit wages, and you kind of have to go through and allocate among each program. So what we typically do is try to start with giving everybody the ERC wages and seeing if we have enough to also do PPP and going backwards from there. So, but some of the things in the upper spreadsheet here is the owner comp comes out of that because we're saying included in that top number for payroll costs is owner compensation of 20,000, retirement costs of 63 and 53, health insurance of 70. All of those numbers can be considered part of the payroll costs, but they are not wages. So that should be considered when you're trying to get $10,000 per person for ERC. This is going to be especially important for 2021 because last year you're limited to $10,000 for the year over your full 24-week period. This year, there's the potential for $10,000 per quarter. So that, I guess, is like over how many quarters? It could be 10,000. It's going to be a lot tougher to maximize between PPP2 and the ERC by quarter. And also, if you're a restaurant, if you have RRF, I mean, really, you're going to, I have one client who says he's going to spend his full time trying to make sure he can take advantage of all the programs. So it'll be tougher next year, but I hear a lot of people say that either a payroll company or their accountant told them that within that 24 weeks, they are not allowed to use those wages for the employee retention credit, which is not true. You cannot use those wages if you needed all of them for forgiveness and you did not include non-payroll costs and you've already filed. If you didn't, you would want to try to reduce your payroll costs to 60%, use the other non-payroll costs to get to your 40% to get full forgiveness and then free up some of the wages. Sometimes it gets a little complicated, less so for 2020, but we could help with that. We answer a lot of questions just if you email the CARES address with some information and then we can help you through like how to get there. But don't think that you cannot use the payroll during your covered period for ERC because there's a lot of flexibility to try to figure out how you can get there.
So this client was an actual example. You'll see on $1.8 million of payroll, he got $520,000 of credit. He got another $177,000 of R&D credit, and he got $750,000 of PPP money forgiven. So he was able to maximize his payroll through those periods to get all three of those benefit programs. One of the things that Kristen mentioned that's very important is that in that, if you do hear that you can't use wages paid during the PPP forgiveness period, That's not correct. You can't use the wages that you use for forgiveness, but you can use the excess wages to get these credits, which is exactly the benefit that's shown in this computation here. And that's where there's a lot of misinformation.
Yeah, so even the people that are over 100,000 that you didn't include those wages, those can be added back for ERC too. Like there's a lot of different ways to get there.
So it's not the first $10,000 in wages that get the credit. It's the first $10,000 of eligible wages to get the credit. So we'll come down to what should we do now? You want to certainly go back and see if you're eligible for the 2020 over 2019 on the first step. Run reports on a cash or accrual basis. Connect with us or your accountants to discuss that, because either way could qualify you. Krista made a comment on the last slide about companies that are spending so much time making sure to take advantage of this. We're involved in one company that will, between PPP 1 and 2 and ERC, will probably get about $6 million of government assistance, which is, and they'll do so much better this year than they did last year or even the year prior because of all this money that they're getting. So putting the effort in is the first thing that you have to do. It is worth it. Do it on your own or reach out, see if we're able to help you, or talk to your accountants or whoever your advisor group is to make sure you're taking advantage of this. If you are not eligible due to the receipts, summarize the impact of the government orders on your company, and then talk to us, and we'll give you our understanding of where it is and whether or not you'll be eligible based on suspension of operations. Calculate the average number of employees who have worked over 30 hours per week or more. That will tell you how many people are going to qualify for this credit. If you haven't filed for forgiveness for PPP, hold off submitting the application until you know how you can maximize the PPP and ERC. Once you get the ERC answer, then you can get your PPP forgiveness in, because you'll know at that point how much you're going to need for PPP forgiveness, which you really want to get that money forgiven for sure. And then the rest of it you can use for credit. And understand the aggregation rules if you're involved in more than one company. Let's review the ownerships, what the companies do, whether one company was affected differently than the other company from government order. We're in a group right now that has 3 companies, and one of the companies was the daycare operation, which was closed for most of the year by government order. Would that make the other companies eligible for this credit just by a closure of government order? So those are great questions that you have to ask yourself if you're involved in more than one group.
We are going to send out, I think, just a very basic spreadsheet with all of the quarters available. If you wanted to fill that out, if there's a tab for accrual and a tab for cash, and send it to that CARES email address, we could help you understand how much you might be eligible for and go from there.
Yeah, and remember, if you're not eligible because of the reduction in revenue, then look at what impact the government action has had on my operations. And even if it's not a financial impact, was it an operational impact? There's 2 good-looking people and some websites.
And somebody on here is asking me how many times I will play with my hair, and I did not think it was very many today, to be honest.
No, I'm still losing weight. We're getting there.
We're getting new pictures, so this will change.
Tomorrow.
Next time there will be new pictures. All
right, so 8-year-old picture won't work anymore. We're going to roll to the questions.
I'm like 14 years old.
Since we have them in there, and we're going to read them and answer them. That's our MO here. If you have not applied for ERC in 2020 but you are eligible, is there a time frame for doing it?
3 years.
Yeah, it's 3-year time frame, but we recommend that you get it done now so that you get your money. Not a bar. Question, if it's not answered during the presentation, am I eligible for ERTC in 2021 Q1 if I was down more than 20% in the fourth quarter 2020 versus 2019 using the preceding quarter rule?
Yes, that could potentially qualify you.
It would, yes. So if you were down 20% in, you're saying you were down 20% in fourth quarter of 2020 versus fourth quarter of 2019, you do qualify for the first quarter of 2021. Yes. My payroll company is charging me $250 per quarter. I think it is reasonable. I think so as well.
I do too.
Yep.
Where I see people getting stuck though is they want you to give them all of the calculations between all the different wages and to be responsible for doing that. So if you're comfortable doing that part, then yes. If not, they're not going to do that. And then they may suggest that you go to another credit company. So
yeah, so just remember that the payroll company is not aware of your PPP forgiveness if you filed it or not. So they're not going to do that allocation.
Or they'll eliminate all wages paid
Yes.
during the cover period.
Yeah, so be very careful with the information that you give them. You got to do the work first to get them to do the applications. But $250 a quarter is very cheap, reasonable. Are any wages excluded from ERC? Owners' wages, wages of family? Yes. So we are including owners' wages at this point, but family of owners are disqualified. I haven't received the first quarter or the fourth quarter of 2020 credit refunds. How long is it taking the IRS to process?
So if your first quarter was an amended return, I'm not surprised. If your first quarter was you reduced your deposits and requested a refund, we actually are seeing those. I heard from 3 clients last week that got checks that they filed by 4/30 and they already received their first quarter refund. But that was not an amended return. I've not seen anyone yet get a refund for the 2020 amended returns. We are telling people 6 months.
Have you found a good source for determining the status of PA Philadelphia shutdown orders?
I typically,
where do you go for that?
It depends. I've been using other states in the ones that I've been doing, but if there's like the governor's order and then they keep, there is a place, I don't know where I got it from. I've just been Googling and then you want to go to the latest one or the one that would be in 2020 if you're amending, and for each state is different. But for PA and Philly,
I'm sure
I think
governor.pa
has some information there. And for Philly, I think it might actually be the health department because a lot of the stuff comes from the health department. If you have a specific one that you would like me to provide, I have identified some for other clients and definitely reach out and I can send them to you.
Well, here we're going to contradict our last answer. Thank you for the webinars. I was able to get with the ERC through my payroll company by amending the returns right after your webinar. I received a large check from the IRS last week. So those checks, this is the first time that we've heard that anybody with an amended return did get paid and they can't believe the amount. So it does work. Yeah. Here's our testament.
It does seem like they are starting to move on them, which is good. There was like no movement for a while.
Does the nominal impact qualify you for ERC credit for all 4 quarters in 2021? It's going to be a by quarter.
No, that one. So the partial suspension of operations only is when the order is in effect and impacting you in that way. That's more than nominal.
Right.
So that one's tougher.
If the government changes the rule and ends it, for instance, full opening of restaurants, then you're going to lose your qualification at that point. I think that's what you're saying.
Yeah. Yes.
I provide energy consulting services out of my home. Many of my customers, including schools, shut down or disallowed outside visitors to their building. This suspended and slowed down my business until I could perform site visits. There's
potential there for sure. If your reasoning is my clients are not paying me or are closed, that doesn't count. They think you'll get there with the receipts. But typically, if a large part of your client base is someone who is impacted in that way, there's a justification somewhere that an order is also impacting you based on you not being allowed in there or how you are able to perform those services. And we don't know if you're ever going to have to submit this information to the IRS. We just do this as a CYA. But you have to look at it more at what is the order that's impacting them and how does that impact you, and you might be able to get there.
So I have a restaurant that was impacted, had to rely on delivery services like Grubhub. Does it qualify me for ERC? Yes, your restaurant is qualified automatically by the government shutdown rules. Yes. If it doesn't qualify by the receipts rules.
Definitely.
Qualified wages, confirming the wages paid to part-time employees are not eligible.
No, they are. Some people, when they get with aggregation or have larger companies, have more than 100 employees. So we mentioned that in 2019, you want to count your average employees, especially if you're close to 100. And in there, you do not include anyone who did not work over 30 hours a week on average. So if you eliminate basically part-time people to count to 100 in 2019 to determine who you can include, but part-time wages are eligible.
Yeah, they do count. And when you do the credit, they count. When you do the head count, they're excluded.
Yes.
We received our first quarter checks, but not 2020. Has anybody seen a check come in yet? Well, we hadn't seen one until the previous question came through, that somebody has received a 2020 check. So I would say that checks are starting to come out at this point. No direct deposit. But I don't have a timeline for that.
Yeah, and I hope that they come out with direct deposit. They did that for the FFCRA, right? It goes directly into your bank account.
Yeah, direct, right.
But it's not available right now.
I have a legal practice that was impacted by courts being closed and participating in virtual hearings versus hearings in court. Revenues decreased 18%.
I think there's some definite potential there.
There's potential there because you had to change the way you did the business.
Yeah.
And it was a nominal change. It was more than a nominal change.
I mean, and the courts being closed, eliminate, that's I would definitely think that has a good one to investigate for sure.
New York City has been a significant part of our revenue of 15%. Would we qualify for ERC for all 4 quarters in 21 due to the government shutdown during this pandemic?
Depends what the service was. So I mentioned New York City in that there's probably an order there somewhere that restricts you from doing, like if you're a restaurant in New York City and you have a restaurant here, potentially, I would need to know more about what is the New York City component of revenue and how it was impacted.
Just to clarify, the PPP forgiveness was 46,000. I stated 20,000. I'm sorry, I meant that for owners or during the 8-week period. No, during the 24-week period, just for the owners of the company. But other highly compensated people were at 46,000. Correct. If an employee earns 150, can you use 100 for wages for PPP and 50 for ERC? Mm-hmm. Yes, that's correct. So that's the excess wages that don't qualify for PPP. Lots of firms have gotten Q1 checks. Is there a way to check on ours? We also didn't get our 2020 check yet.
Q1, again, if it was amended, like you did it after April 30th and not through the payroll company with the regular filing, I'm not surprised because none of the amendeds have been processed yet. But if it was filed by 4/30 with the request for refund, I think you should see it soon, but there is not a like, where's my refund? Like there is for personal taxes yet. So I would imagine you would see it soon if it was the regularly filed 941, but the amended, we haven't seen anything yet.
When you say you need to be down 50% in sales in 2020 and 20% in 21, what do you mean by 20% in 2021 compared to 2020 or 20% down as of 2019? So you compare your 2021 quarters to your quarters in 2019. You skip the 2020. So everything is compared to 2019, even the 2021. In a sole member LLC, how is the credit used or applied?
If you don't have payroll.
If you don't have payroll, you're not going to get the tax credit because it's a credit against your payroll taxes. But if you have payroll in your sole member LLC, your credit will just return to your operating expenses.
Yeah. And there, there might be some benefit there for you with the FFCRA. Like if you had sick time for yourself, you might be able to do something with your tax return there.
The business was purchased at the end of 2020, but saw a decrease in revenue in 2021. Would that business still qualify?
The end of 2020, I don't think so.
I don't think it's going to happen because we had a situation like that where they could not go back and compare to 2019 because it was not their company. Now, if it was a stock purchase,
right,
then you may qualify because you are buying the stock of the company continues its operations. But if it's an asset purchase, I don't think you can go back because you're in a new company.
You know what? At that point. So I haven't done this one yet, but that recovery startup is for businesses after 21520. So you may be able to do that if your receipts are under $1 million. We haven't done that one yet, but I think we're talking later. So I will look into that and see how we would. That's the one that just came out with the ARPA in March. So it's new. So it's for new businesses that started during the pandemic that don't have a history and they want to give them some relief. We've not done that yet. So this would be the first one we would look at. So I will let you know about that.
So is it usable cash in the business? Can it be taken as distributions? What is its taxability? So it is a reduction of the amount of tax that you're paying. So if you are reducing your payroll taxes, then your costs are less. That is taxable. If you're getting a check back for payroll taxes that were already paid, it is taxable. What you do with the money, there's no restrictions or no requirements on that money. You can take it as a distribution. Just know that if you're in the 30% tax bracket, you're going to owe 30% of that back in taxes.
Hello.
Do we get a credit for lost time due to people being quarantined and testing weekly?
Yeah, well, so after April 1st, you'll get, if somebody was out.
This is for the FFCRA.
The sick, that would be under a different program, but there is some relief there under the FFCRA sick leave. That's now goes through the end of the year also, but that's a different program that you do also run through payroll.
Yeah, Bernie, send that question to us by email because you might have it might be a different question actually. Are owner's wages combined with eligible expenses allowed to be used for forgiveness? Then the remaining wages used for ERC? Yes, we answered that earlier. So the owner's wages that are used for forgiveness aren't eligible, but anything in excess are. I added COVID protocols in a medical practice causes fewer patients per day. Is that a nominal impact?
Potentially.
Potentially, yes. So we have to look at the circumstances of what you did and what the requirements were. Let's look at your revenue. That could help.
Yeah.
But yeah, that's like the dentist.
You did it because you want to be safe and show that you're a safe practice. No, if you did it because the government said you can't open or, people can't be in there unless you do these things, then that's a better case. If it's a choice by the business owner, it's definitely not. But if it's because of a government order in a medical practice, there's a good potential there based on the numbers. So we've talked about that if you want to reach out.
Is there a credit for lost time of people being quarantined and being tested weekly, but still getting paid? There is a different program that addresses that in 2020, and then it was restarted April 1st of 2021 and runs through September. That's a different program. If you send us an email, we can send you the details on that. If we didn't take ERC in 2020, but received PPP, are we able to apply for ERC and redo our 941s with the adjustments? We were down 80%. Yes, you can still, if you qualify for ERC and the PPP. Yeah, the original rule was you did one or the other, but that was changed this year and allowed to be retroactive back to 2020. So the answer to the question is yes, you can do both as long as you qualify for both. The only caveat is you just can't use wages for PPP forgiveness in order to get the credit.
Yeah, and it sounds like almost, I think, potentially all 4 quarters are eligible, and I will talk to you about that. I think you'll be able to get a decent amount of the credit depending on what your PPP looks like, but I think for sure you'll probably have at least 3 quarters available.
If half your quarter is covered with the PPP, can you claim the amount not PPP covered for the ERC funds? Yes, you can, but you can also go back and claim some credit for the period of time that got PPP coverage. Any excess money or any amount that you didn't need for PPP. Remember, PPP only required that you use 60% of the funds for payroll and for payroll costs. So there is an opportunity to use that same employee part for PPP and part for ERC. It's not one doesn't exclude the other. Does PPP incur debt forgiveness rules? PPP forgiven debt is not taxable if that's what you're asking.
Right.
New York City follow-up question. Job site in New York City closed in 2020. customers not accepting deliveries, job sites closed, and our annual sales were 15% historically. Would this qualify us for ERC in 2021?
If that was a construction thing, potentially so, because you're not allowed to do business there as a construction site. But customers not accepting deliveries would not qualify. But if you were, scheduled to do a construction job there and you're not able to because an order said no construction, there's a pretty good chance that that would qualify you for that during that time period. I'm assuming from job sites might be in construction.
This one's yours. Anybody that writes in capitals.
We acquired a company in late 2019. How do we measure revenue changes? 2020 would have a full year. I think so if there's a full year in 2020, I think you measure 2021 over 2020. I'll double check on that, but it's pretty clear. It's clearly defined with some recent guidance. But I think you would measure it against the same quarter in 2021 if you have a full year in 2020.
But measuring a full year of 2020 against 2019 would use the average. The 2019 would be averaged out as if it were a full year. Yeah.
Okay. Yeah.
So you would take the average. Yes. Mm-hmm. So if you had one quarter of 2019, you would multiply it by 4.
Yes.
To get what your average would be per month in 2019. We would qualify for ERC in the second quarter of 2020 only. We received first round PPP money on 5/5. Our payroll costs will more than cover the PPP loan amount. When I compute PPP forgiveness, how do I do that? Use the dates.
No, I would use the real dates, the 5/5 date, and use the full amount of payroll that you possibly can. And if there's enough wages in both of those to do ERC and PPP, that's fine to put it on there. So let's say it's like $100,000 loan, and you put $200,000 of payroll costs, and you get full forgiveness, and don't put any non-payroll costs. What you cannot use for ERC is $100,000, even though the 200 is listed. It's only the wages that are actually used for forgiveness that you can't use. So I would put, because then it's going to be too tough to tie it all out and submit the documents, and you're going to get questions from the SBA.
Yeah, I would, Lisa, send an email and we'll try to walk you through it by an email. And our last question was, thank you very much. You guys are amazing. Kristen keeps telling me that.
I was going to say, Bob loves to hear it, but
but thank you.
Yeah, keep
we have a couple of, somebody raised their hand somewhere. We got a couple of questions. Still
non-taxable.
Is it correct ERC is taxable? Yes. PPP is not. When you are saying ERC proceeds are taxable, are you saying that a not-for-profit has to report it as unrelated business taxable income?
I need James.
We are not saying that because it's not income, it's a reduction of cost. So when it comes to the unrelated business income, there has not been any ruling on that at this point, except that we know that many not-for-profits are accepting ERC payments back.
There's definitely some concerns with non-for-profits, especially if there's like the contract stuff. We have a person here, if you wanted to reach out with some more questions that I can connect you with, that is a really good resource for nonprofits, less so.
Yes, it is a specialty. What else? If we want to make the application myself, since my payroll company said they cannot go back in time, do I file a 7200 form for Q 2020? No, you want to amend your 941 form for your 2020. And any 941s, any quarters that you've already filed, so you've already filed the first quarter of 2021, you need to amend those returns to show and to get back the credit on those returns.
Yep.
A 7200 is only if you're asking for the IRS to advance you money for a quarter that you know you're eligible. Mm-hmm. So if you've already filed the 941s, you just amend it. 941C is the form. If gross receipts for 2021 are down 20% compared to 19, what would also qualify me for proceeding Q1? So Q1, you want to measure against Q1 of 2019. If you're down by 20% in that quarter, you qualify. Looking at Q3 of 2021, would it automatically be eligible since preceding quarter was eligible based on being down 20%? Yes, you're automatically eligible for that next quarter as well. So take the credit as you're going to get into your third quarter. And if you qualified for the first quarter, you're now in the third month of the second quarter. So make sure you're taking the credits for the second quarter as well.
I think that might be it. That's the one he put in the chat.
Okay. We're scrolling up, I think we're almost done.
I think we're good.
I think that's all of them. There's one Q&A left.
Thanks.
Thank you.
Thanks.
All right. So here's our contact information. Again, send us an email. We'll try to get back to you as fast as possible. If anything occurs to update these programs, we will certainly schedule another webinar. We've probably done 25 of these, and there's no real schedule for them, but we are trying to make sure everybody gets an opportunity to take advantage of these programs that are very valuable. So thank you again. Enjoy your week, and look forward to talking to you shortly. Thanks again, guys.